Hey guys, welcome to another episode on the Joan Wick channel. Today I'm going to go over mitigation blocks as well as breaker blocks. If you remember, I have spoken about breaker blocks in the past, but as you'll see, I took that video down. I think that video does need an update, and so I thought that perhaps we can make this a double lesson, because I do think it becomes quite clearer for both concepts if we compare both mitigation blocks and breaker blocks side by side. Why? Because they're very similar, but they're very different as well. And a lot of people get confused because of this. So let's get into it and let me make it a bit more clearer. So let's get right into it. Remember, order blocks are measured from the bodies. Within a trend, we usually would retrace and respect those order blocks as a point of interest. To what? To continue the trend. So what breaker blocks are, is essentially price breaks that level or disrespects that order block and reverses to continue the trend in the other direction. So this now becomes our breaker block. So a mitigation block is essentially similar but different. We take this example again. We will find our mitigation blocks in a continuation of a trend. So if this was our breaker block, that means this breaker block would become our mitigation block, like that. Remember, you still have your order block on this leg. The breaker block or the mitigation block is the candle or the swing right before that order block. So looking at this example, after we've made our liquidity sweep, you see price takes out this previous low, then break structure. We have our breaker block right here. From the wicks, it can be the series or the single candle measured from wick to wick. Remember, we measure from body to body with an order block, but with the breaker block we measure from the wick, and it can be the series or a single candle, and we see that price respects the 50% of the breaker and continues the reversal direction. And so that now we are trending, we no longer have breaker blocks, because why? These breaker blocks within a trend are not called breaker blocks. They are our mitigation blocks. So that would be our mitigation blocks. You see price respects that nicely. And continue. So you see the difference between the two. Easy, right? Well, let me show you something. When we have a reversal between two markets, say this is Nasdaq S&P, and they both take out a high time frame PD array, and we see a swept liquidity, and we make a little SMT divergence over here. This is where some people will get confused, because they will label this candle as our breaker block, when in fact this is a mitigation block. Why? Because this is a failure swing. We did not sweep this previous low like this one, where price reversed, and therefore this was a breaker, because why? We find breakers at reversal points. But during this reversal we had a failure swing. That means we've already started the trend. And where do we find mitigation blocks within a trend? They are breaker blocks within a trend. So when you're looking for a sweep of liquidity and a reversal point, just remember, when we have an SMT, The one with the failure swing creates the mitigation block, not the breaker block. The one where we do sweep the low or in the high in case of the opposite direction, we are creating a breaker block. So let's look at another example of how we use both. We have a sweep of liquidity, a market structure shift. We break this high and we start reversing. This, if you remember, this would be our breaker block right here. Boom, see price respects. Then what would this be? This would be our mitigation block right here. Mitigation right there. Mitigation right there. Right there. But I'm going to show you another way to use mitigation blocks. It's not just on the trending side of the curve. If you're looking at the other side of the curve, we can use mitigation blocks on the other side to enter as well. So what mitigation blocks look like on the other side of the curve, they are our old order blocks. So those are also called our mitigation blocks. When you find these old order blocks that have not been mitigated, haven't been tapped into, price will, once reversing, use those old order blocks as areas of interest for price to tap into on the other side of the curve. See, so you would enter or expect price to retrace on the buy side of the curve at those areas. So you can look for retracement opportunities where you see unmitigated or old order blocks that have not been tapped to on the other side of the trend. So essentially what I'm saying is breaker blocks we'll use during a reversal, and we want a sweep of the lows to validate a breaker block. And what they are essentially old order blocks that failed to hold. And what mitigation blocks are essentially old order blocks on the other side of the trend, or breaker blocks in continuation of the trend, and we use them as areas for retracement opportunities when taking a trade. So breaker blocks are useful when catching reversals, and mitigation blocks are useful for entering on retracement, because price tends to revisit areas where price has accumulated in the past. Let me finally show you a candle example. We swept the lows on S&P here. We did not sweep the low on NASDAQ here. So what do we have? A failure swing on NASDAQ, meaning we have our mitigation block. And over here we have our breaker block. Right? Now if you see along the other side of the curve, you'll see what I mean by price reaccumulating or retracing in the areas where price has made previous order blocks. You can see there are areas where price has tapped into that area, and you'll find opportunities to enter along a trend when price retraces to those zones. You can see the exact same example over here. Price is retracing at that area for each mitigation block, and that provides us nice opportunities to re-enter. You'll notice that when we're looking for mitigation blocks, we're measuring them like we measured breaker blocks from the wick to the wick. But when you're looking for mitigation blocks on the other side of the curve, we're looking for old breaker blocks. So remember, we measure breaker blocks from body to body. So just remember, you measure them differently. Let me show you how to apply them within a strategy. So I've linked the Blockbuster strategy in the description, and that basically tells you how to apply breaker blocks and order blocks in your entry, and I'm going to show you exactly how that works. So for breaker blocks, we want three things. We want a sweep of liquidity, we want a market structure shift, and the third thing we need is a fair value gap that's overlapping our breaker block. I'll make that breaker block in red. And so when we have those three things, we have high probability for our breaker block setup. So after our market structure shift, we'll enter on the breaker, the start of the breaker, stop loss just below the breaker block, and then target previous swing highs. All these swing highs become potential targets, as well as other forms of liquidity like these fair value gaps. That would be our entry. So if you were taking this trade but on the other market, you can do the exact same thing. Just remember that with an SMT, we don't require a liquidity sweep, so we can apply the same steps, but this time this will not be a breaker block entry, because remember, we don't have the sweep of the low, and so we can consider this within a trend. And a breaker block within a trend is a mitigation block, and we can treat it the same as a breaker block within the strategy, where we find a overlapping fair value gap with the mitigation block. So we can enter on that mitigation block, stop loss just below it, target the highs, same thing as previously. Just like that, targeting all those highs as well as liquidity resting above. So when it comes to these mitigation blocks on the other side of the curve, we want to enter using overlapping confluences. So we see prices revisited this area before. We can enter on that mitigation block, stop loss just below or at the swing. We can target highs like previously, and with this one we can enter on the overlapping fair value gap, stop loss just below or on the swing, and targeting highs just like that. So all in all, breaker blocks are essentially found at your reversals and require a liquidity sweep, whereas mitigation blocks are areas where price will reaccumulate, and you'll find them to be either old order blocks on the other side of the curve, where price will retrace and you can find retracement opportunities, and where we can use them in continuation of the trend as well. I hope that was a good explanation. Let me know in the comments, and please hit that like and subscribe button. There is a free PDF link to the strategies that I give out for free, so please check that out, and I'll see you guys in the next video.